Good morning. We've got new information regarding home values, unemployment, and home buyer demand. Let's get to all of the specifics and start digging into how this will affect your business. Let's jump into the bottom line. Good morning. We're really excited to be kicking off the new year with you here. We've got some new reports and new market data. So, as always, let's start with the staples. And this is for the purposes of giving you a clear picture on buyer demand. And what better way than to do that with the Mortgage Bankers Association weekly application survey, as the loan application tends to be the very beginning uh, steps to buying a home. And so, with regard to that, we saw applications to purchase a home decline by 12% in the week ending December 30th. And though we would expect to see some seasonal decline for this particular holiday week, this does represent the biggest decline that we've seen in this area in the last 3 months. That does put us down negative 42% when compared to this same time frame last year. Although the last 2 weeks have been holiday weeks, so we really should take these reports with a grain of salt and turn our attention more towards future reports to start off 2023 to get a better barometer of where the market is truly at. Now, the average interest rate for a 30-year fixed rate mortgage plays a big role in buyer demand, of course. And so we always want to keep a close eye on where things stand with that. And for that, we also have the MBA survey, which surveys a variety of lenders to get the average interest rates that are being offered up. And that went from 6.42% to 6.58% for conforming loans. And that means loans that have a balance of less than $647,200. To help give perspective, this puts rates back to where they were in mid November, which is down about 1% from their peak in October. And for more positive news, the projections are that rates are still going to continue to decrease longer term across 2023. And this is because inflation is expected to continue to come in lower with each report. And we also got some housing news from CoreLogic, and they released their home price index for November, which showed modest declines. Home prices down 0.2% for that particular month, and up ending the year on a year over year basis 8.6%. So we are definitely seeing some deceleration, meaning the future increases to home prices has started to decline. But that doesn't mean that home prices are starting to decline, just the future valuations of them increasing. And they actually are holding their gains pretty well in the face of a pretty tough market after some real appreciation that we've seen recently. So another big component of this is going to be unemployment. So, Justin, why don't you jump on here and tell us a little bit about unemployment and what we can expect with that?
Thanks, Jake. So, to give you some context as to why unemployment is an important metric to keep an eye on, this is because the Fed is being tasked with two things: controlling unemployment levels and in controlling inflation levels. So, one of the factors that the Fed uses is determining if and how much they will increase the Fed rate is unemployment. Let's look at the data ending back in week of 12/24, just prior to Christmas. This showed that the initial jobs claim came in at 225,000, which is a little bit higher than the 4 week average of 221,000. This is nothing too concerning, though, but the initial claims are tracking people who are applying for benefits for the first time. There's another metric we want to pay attention to, which is continuing claims. This is going to be for people who have already been on unemployment, looking for work, and are still continuing to make claims. In the past 3 months, we've seen this figure increase by almost 400,000 claims. In this report alone, it was up another 40,000 just for the week. This brings the total number of continuing claims up to 1.7 million. This could start to paint a picture of a potential weakening in the jobs market, which means that as more people recently are beginning to become unemployed, they're having a much harder time than in the past on re-entering the workforce. This could be one of the leading signs that the economy could be starting to show some cracks in it, which could likely be favorable for interest rates and therefore home buyers moving forward. Thanks for your time. Back to you, Jake.
Yeah, thanks, Justin. That's great info and something we'll definitely want to keep an eye on each week to try to keep our finger on the pulse of this situation. So let's dig deeper into that subject, though, and let's look into the recent BLS jobs report that we just received, which showed 223,000 jobs created in December, which was a lot stronger than expectations, which were at only 200,000. Keep in mind, though, that there are two surveys within the jobs report. Okay, there's the business survey, and then there's the household survey. And there's some critical differences between the two. The business survey is where the headline job creation number comes from, including a lot of modeling and estimations from experts. Now, the household survey is where the unemployment rate comes from, and this is derived from calling households and just asking to see if they're employed. Now, the household survey has its own job creation component, and that showed that there were 717,000 job creations. Now, while the labor force increased by 439,000, so way more jobs created than increase in the labor force. This caused the unemployment rate to decline from a revised 3.6 down to 3.5%. And the labor force participation rate, so how many people are actively participating in the labor force, increased from 62.1% to 62.3%. Now, this here would be the highest level that we've seen since August. Now, when we break into these numbers, though, and we start to play detective, right, we look a little bit deeper than what's on the surface. Of those 717,000 job creations in the household survey, 679,000 of them were from part time workers. So that leaves only 38,000 new full time jobs. Now, this could be a lot of holiday hires or people getting part time work during the holidays. Um, but 380,000 of these people were what they call multiple job holders. So this is, I already work a job and now I need to get another job. So that's likely people who are either working a full time or an already part time job and they need an additional job to try to make ends meet. And additionally, we got reports that showed wage growth has slowed in the month of December. Average hourly earnings were up only 0.3% in December. And this is important because this is a metric that the Fed has mentioned time and time again, that wage pressure is being sticky. And this is a figure that they want to see start to come down. Now, whether or not the Fed acknowledges it, this is going to help with inflation and the wage pressure component of it at the very least. And lastly, we saw the average weekly hours worked decline from 34.3 or down to 34.3, I should say. And this is the lowest level since 2020. Now, while job gains were strong, the cut in hours would actually equate to a significant amount of jobs lost. Now, we look forward to getting additional data. We're very early on in the year. Sometimes this can be hard to read the information as a lot of the indicators we get in this business are lagging indicators. So the reports we're going to get in the month of January are going to be looking back in the rearview mirror, so to speak, to November and December. But as we get further into 2023, we're going to start to see how this year is beginning to take shape. And we're going to be here each week to bring you the relevant data and how that plans to impact your business right here on the bottom line.